Hi everyone, my name is Rubiati Inaya. I'm a student from MBA Program of IFMI Institute. Today I would like to present a conceptual approach to understanding corporate finance through the use of mind mapping, who is lectured by Professor Roy Sambel. Corporate finance is a comprehensive and interconnected field covering key areas such as financing decision, capital structure, dividend policy, risk management, and firm value. In corporate finance fundamental, we will talk about 6 critical issues. The first one is financial management. Focus on the foundational principle and governance of corporate finance. Goal is maximize firm value, where the primary objective is not just to maximize profit, which can be short-term, but to maximize the current stock price or the market value of the company. This ensures long-term sustainability and wealth for shareholders, where the function is the financial planning, analysis, and control. We will talk about the theory of principal-agent relationship. And the second one is investment decision is capital budgeting. Focus on the left side of the balance sheet, deciding which long-term asset or project to acquire. Risk basic and measurement, return measurement such as ROI, IRR, time value of money, future value, present value, and project analysis and interaction. This is analyze whether projects are independent or mutually exclusive. And the third one, we have capital structure. Focus on the right side of the balance sheet, deciding how to fund the asset. Next is dividend policy. Focus on the returning value to shareholder. Cash payment to shareholder, deciding how much profit to distribute as. Dividend versus how much to keep as retained earning. Retained earnings are used to fund a company growth. Dividend return analysis. Next, we have financial market and investment. Focus on the external environment where the capital is raised, meeting of supply-demand for securities, financial institution, and intermediaries, securities analysis, ratios, fundamental and technical. And the last one is financial risk management. Focus on the protecting the company's value. Fraud risk management is internal control and audits designed to prevent embezzlement, accounting scandal, and misuse of company asset. Principal-agent relationship is a relationship where one party, the principal, delegates work and decision-making authority to another party, where the agent. The branch one is the player, means the relationship. The principal or shareholder means that provide of a capital money, they own the company but do not run its daily operation. The goal is maximize wealth, increase stock price, and dividend. The risk is they bear the financial risk if the company fails. The agent, managers or executive role is the brain hired to run the company. They have the expertise and operational control. Goal is maximize their personal utility such as salary, job securities, reputation, and peaks. Risk is they also risk their employment and professional reputation. And the second branch, we have the agency problem. The conflict is the core issue, where the separation of the ownership and the control because the owners are not the ones making the decision. The next is agency costs, the reduction in firm value resulting from the agency conflicts. And the last one, the good corporate governance, which is apply transparency, accountability, responsibility, independence, and fairness. Next, we have capital budgeting. Net present value is a financial metric used to calculate the total value of an investment opportunity today. It helps you to decide if a project or investment is worth the cost by comparing the money you will spend now against the money you expect to receive in the future, adjusted for time. Money available today can be invested to earn interest. Inflation reduces the purchasing power of future money. Future cash flow carry risk you might not actually get paid. Therefore, future earnings must be discounted, reduced in value to see what they are really worth in dollars today. Internal rate of return, or IRR, is the financial metric used to estimate the profitability or potential investment. While the NPV tell you the value in dollars, IRR tell you the percentage return you can expect to earn annually. IRR is greater than the cost capital. It is accepted when the project returns more than it costs to fund. IRR is less than cost of capital. It is rejected when the project returns less than the cost of funding. When the IRR is equal to cost of capital, it is equal or neutral when the project breaks even. The profitability index, also known as the value investment ratio, is a financial tool used to measure the bang for your buck of the project. The payback period is a simple financial metric that tells you how long it takes for an investment to pay for itself. It measures the amount of the time required to recover your initial investment cost from the cash flow generated by the project. The capital structure. We will talk about the financing decision, debt versus equity, optimal financial mix, funding details, cost of capital, WACC means weighted average cost of capital. Number 1, equity. Owner's equity or owner's capital. The components is common stock, preferred stock, and return earning. Pros is no mandatory payment, no risk of bankruptcy from failing to pay dividend, but the contra is most expensive source of capital, dilutes ownership and control. Next one is debt financing. Debt financing components such as bank loan, corporate bonds, debentures. The pros is interest is tax deductible, tax shields, owner do not lose control. The third is cost of capital. This is measuring stick for the capital structure. The harder rate is to maximize firm value, you must minimize the weighted average cost of capital or WACC. The goal is optimal capital structure. The company don't just pick just a number of a random. They aim for optimal capital structure, the specific mix that maximizes the company market value while minimizing its WACC. The fourth is measurement ratio. How analysts look at your structure. Debt to equity ratio means that total debt divided to total equity. Debt ratio means that total debt divided to total asset. Interest coverage ratio, where the EBIT divided to interest expenses. It measures the ability to pay the interest. The next one is dividend policy. We will talk about the cash payment to shareholders, dividend return analysis, dividend yields, annual dividends divided to stock price, and payout ratio, where the percentage of earning paid as dividend. In the dividend policy structure, we have the decision-making process regarding how much of a firm earning are paid out to the shareholder versus how much is reinvested in the company. The trade-off is dividend immediate income versus retained earning or future capital gains. Next, we have financial market investment. Meeting of supply and demand for securities, financial institutions, and intermediaries, security analysis such as ratio, fundamental, and technicals. And the last one is the financial risk management. We have to present about fraud prevention such as internal control and audit. In financial risk management, number 1 is occupational fraud and abuse. There are 3 things that a financial risk management in the company, such as corruption, asset misappropriation, and fraudulent statement. Reason for occupational fraud such as huge personal debt or losses, lifestyle beyond income capacity, over speculation in get-rich-quick scheme, gambling, perceived unfair treatment by the company, pressure from a family or certain group, alcohol or drug addiction, or love affair with the same office. In 7 Shenanigans, we learn how to reduce the financial risk by recording the revenue too soon, recording the budget revenue, boosting income with the one-time gains, shifting current expenses to a later or earlier period, failing to disclose all liabilities, shifting current income to a later period, and shifting future expenses into the current period. And the fraud prevention, we have to build ethics, determine and apply SOP, train about fraud, protective security, and the last one is whistleblower. That's all about my mind mapping presentation. Through this presentation, I aim to demonstrate how mind mapping can serve as an effective tool to strengthen our understanding of corporate finance and support better financial analysis in real-world business situations. Thank you.